So, you're hearing the headlines, gold to $5,000 an ounce, maybe even $10,000? And look, they might be right. But what they're not telling you is that the last time things felt a little like this, it wasn't the dawn of a new bull market, it was the setup for a brutal, painful correction. There's a critical flaw in their thinking that almost everyone is missing, and I'm going to show you what it is. This isn't just another video throwing a magic price target at you. This is about something far more important, learning to read the forecasts themselves. It's about seeing what the so-called experts miss and knowing the difference between a real signal and just dangerous market noise. Section 1. The problem: a consensus built on sand. Let's be honest, the case for gold right now feels rock solid. You can't escape it. Turn on the TV, scroll through your feed, and the optimism is deafening. You see headlines quoting high-profile strategists calling for gold to cross $5,000, with some laying out a long-term path to $6,000 or even higher. And the story they're selling is powerful. We've got stubborn inflation, geopolitical chaos that seems to get worse by the day, and a mountain of global debt that makes the whole financial system feel like it's built on a fault line. The biggest piece of evidence everyone loves to point to is central bank buying. For the last several years, the world's central banks have been buying up gold at near record levels. The World Gold Council has been tracking this, and it's a big shift from how they operated in decades past. This isn't just a small trend, it's seen as the ultimate insider move. The managers of the world's money are hedging their dollar-heavy reserves with a hard asset. They're getting ready for a different world, and it looks like gold is their asset of choice. When you mix that institutional demand with very real public fear, you get a story that's hard to argue with. It feels like a one-way bet. Millions of investors are jumping in, from big ETFs to people buying their very first gold coin, all thinking they're protecting their wealth from a coming storm. The logic is simple: if the system is shaky, own the one thing that survived every crisis for 5,000 years. That's the mainstream story. And it makes total sense. Until you look a little closer, what if the models everyone is basing these predictions on are fundamentally flawed? What if the very thing that seems to be pushing gold higher is also a warning sign of a catastrophic market turn? Gold is a forecast magnet. It attracts these huge, headline-grabbing numbers because it taps right into our deepest fears and hopes: inflation, war, recession, and the dream of a perfect safe haven. It makes for simple, catchy stories, even when the reality is dangerously complicated. The story today is that gold is your ultimate shield. But history tells a much messier tale. Take the late 1970s. The parallels to today are pretty spooky: runaway inflation, geopolitical shocks, and a total crisis of confidence in the government. After the US dollar was officially untethered from gold in 1971, the price went on a legendary tear, surging from around $35 an ounce to a peak near $850 in 1980. It was an incredible gain of over 2,000% that cemented gold's reputation as the ultimate inflation hedge. But what happened right after that peak? Gold entered a devastating 2-decade-long bear market. Anyone who bought at the top thinking the party would never end was absolutely decimated. Now think about 2008. When the financial crisis hit, everyone assumed it was gold's moment to shine. And it was, eventually, but not at first. During the absolute worst of the panic, as Lehman Brothers was collapsing, gold didn't soar, it crashed. It dropped nearly 30% in just a few months. Why? Because institutions were so desperate for cash to cover their other massive losses that they sold the one liquid thing they could: their gold. It was only after that dash for cash was over and the central banks started printing trillions that gold began its next historic rally. These moments in history expose the hidden flaw in today's rosy forecasts. The models are just too simple. They treat gold as a simple, one-way hedge against fear. They forget that it's also a liquid financial asset that can get dumped in a panic, and they ignore its greatest weakness, the cost of holding it. So how do these forecasts actually get made? It usually boils down to two things: fundamentals and technicals. Figuring out how they work and where they fail is how you protect yourself. Fundamental analysis is the why. It's the big picture stuff: inflation, interest rates, the strength of the dollar, geopolitical risk, and all that central bank buying. For gold, the big one is real interest rates. That's just the interest you get from a safe bond minus the rate of inflation. When real rates are low or negative, you're losing money by holding a bond. That makes gold, which pays zero interest, look a lot more attractive. But when real rates are high, bonds offer a sweet, risk-free return, which is a major headwind for gold. It's a powerful relationship. But here's the catch: that rule isn't foolproof. Lately, we've seen that connection get a little fuzzy, with gold staying strong even when real rates weren't all that low. If you rely on just this one indicator, you're making a classic mistake. A forecast might be right about inflation, but completely wrong about how the Federal Reserve will react. Fundamentals tell you the story, but they are a terrible tool for timing. That's where technical analysis is supposed to help. This is the when. Technical analysts don't care about the why, they just look at price charts, searching for patterns, trends, and momentum. They believe all the news and fundamentals are already baked into the price. Technicals can be a great way to read the market's mood or spot when a trend is getting tired. But this approach has a fatal weakness too: it can be completely blindsided by the real world. A chart can look perfectly bullish 1 minute, and then a surprise inflation report or a geopolitical shock can send prices into a nosedive the next. Technical analysis is about probabilities, not prophecies. The chart doesn't know what's coming. And here's the real problem: most forecasts you see just slap these two imperfect tools together and sell the result as a sure thing. They cook up a great fundamental story and then cherry-pick a chart pattern to confirm it. This creates an illusion of precision that is both incredibly misleading and dangerous. If single-point predictions are a trap, how do smart investors really think about the future? They don't bet on one number. They map out the possibilities. It's called scenario analysis, and it's a total game changer. Instead of asking, will gold hit $5,000? You need to start asking, what has to happen in the world for gold to hit $5,000? This is exactly why major institutions, like the World Gold Council, rarely issue single price targets. They give you scenarios. Let's build a quick version of what that looks like. Scenario A, the Goldilocks disinflation. This is the world where inflation cools down nicely, the economy stays strong, and the Fed can cut rates without a hitch. This is a bad scenario for gold. A stronger economy and dollar would probably send money flying out of safe havens and into riskier assets. Scenario B, sticky inflation and high rates. This is the messy, frustrating middle ground. Inflation just won't go away, forcing central banks to keep interest rates painfully high for longer. Here, gold could just chop around in a wide, volatile range. The inflation story would support it, but the high real interest rates would be like an anchor holding it down. Scenario C. The hard landing recession. In this world, the Fed's aggressive rate hikes finally break something, and the economy slumps into a major recession. At first, you might see a 2008-style dash for cash where gold sells off, but that would likely be followed by a fire hose of government stimulus and rate cuts, creating a massive long-term tailwind for gold as investors run for safety. Scenario D. The geopolitical shock. This is the ultimate wildcard. A major escalation of a global conflict, a new debt crisis, or some other black swan event could trigger a sudden violent spike in gold prices as a pure fear trade takes over. See how this changes the game? It moves you from being a passive listener to an active analyst. You stop looking for a number and start looking for evidence. You start asking much, much smarter questions. The biggest danger in any market isn't being wrong, it's being overconfident. It's the absolute certainty of a forecast that lures investors into making terrible mistakes. When you think a prediction is a sure thing, you buy at the top full of FOMO. You overconcentrate, dumping way too much of your portfolio into one asset you're convinced can't lose. And you become primed for panic. The second the market doesn't do what you expected, like gold falling in a crisis, your whole worldview shatters and you sell at the absolute worst time. So how do you defend yourself? You become forecast literate. From now on, whenever you see a big, splashy headline predicting gold's future, you need to ask 3 questions. What are they not telling me? What are the hidden assumptions? Are they assuming inflation stays high forever? That the Fed is guaranteed to cut rates? That central banks will keep buying at the same pace? What's the counter argument? What would have to happen for this forecast to be dead wrong? Is this analysis or just a story? Are they giving me a balanced view, or are they telling me a thrilling tale designed to make me feel scared or greedy? Learning to see the market this way, as a complex system of competing scenarios instead of a simple bedtime story, is the most valuable skill you can build as an investor. It's how you go from being a pawn in the market to being a player. If you want to keep learning how to decode these hidden risks and see the markets with more clarity, make sure you subscribe. So, let everyone else obsess over a price. We'll be watching the system itself. While they're blinded by the promise of a single number, we'll be looking at the whole map. And in a world this uncertain, having that map is the only real safety there is.